So
there.
I do want to just pause here briefly for a moment to talk about the fact that this is crazy. Like the purpose of taxes, and I mean, you could speak to this more, Erica and Catherine, better than I can as the experts, but my understanding is we get taxed because there are services, there's government, we want structure and society in our lives. We want schools, we want these different things that taxes provide. And if I don't live there, I am not being provided anything. And I'm also not a drain on their system where they need to tax me. This seems wild.
Yeah, that's absolutely right. And the line has to be drawn somewhere.
Hello, and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Hulehan, and we are back today with another episode with my co-host, Erica York. And we are joined by Katherine Loughead, Director of State Projects at Tax Foundation. Imagine you're a babysitter or a nanny, and for an hour, you babysit across state lines. Should you have to, file a tax return in that state? Well, the answer is in some states you would, which seems like it's absurd. So that absurdity is sort of the jumping off point for today's episode. And I'm wondering, Katherine, could you kind of explain to us why this matters and what's going on here from your perspective?
Yeah, well, so the issue of people living in one state but sometimes working in another is really nothing new. At some level, people have been doing that for a really long time. And there have always been state income tax implications of doing that, because one of the basic features of the income tax is that states have the authority to tax you both where you live and where you work. And so when those places are one and the same, that's really easy. You just file in your home state. But when you live in one state, but sometimes or even frequently work in another, non-resident income tax laws start to come into play. And these laws can get very complex and burdensome really quickly. And they can put individuals and employers on the hook for all kinds of filing, withholding, and payment obligations, sometimes in multiple states. And this can even, in the worst situations, result in true double taxation for remote workers. So these laws have been around for a really long time, but people are running into them now more than ever because with the rise of the internet over the past few decades, and then more specifically with the rise of remote work since the pandemic, and with even the technological shifts we've seen since COVID, where we weren't really doing video conferences like this until COVID. But now this is just so commonplace. And now people work from everywhere they have internet and are constantly moving while working. And so people much more quickly run into these non-resident laws now than they did even a decade or two ago. But the problem is state tax laws are really not keeping up with this at all. So a lot of these non-resident provisions were kind of in place from the beginning of state income tax laws, or were adjusted a little bit over time with some credits for taxes paid to other states being brought in, and different things we'll talk about in this podcast, like reciprocity agreements, all coming into play over time. But for the most part, these are really antiquated laws that are now really aggressive and binding for our modern, really highly mobile workplace era. And so we're seeing that a lot of people are running into these laws, but most people don't even know about them. And not many people are actually complying. And then enforcement is also really low too, where state tax departments, for the most part, aren't going after people other than really high income earners. So there's just a big mess of a lot of different burdens, a lot of complexity in different systems. So it would really be great to try to sort some of this out. And the ball is really in the court of states to try to do that.
It sounds like a really big mess. So you have these old laws on the books, the non-resident income tax filing requirements, but you have these big shifts in how people are working and an increase in remote work. I mean, Kyle and I both work remote for Tax Foundation. So 2/3 of the people on this podcast right now work remote full time. And Katherine, I think you, the people, you're now remote too, right? You moved. Okay.
100% of this call is remote. So,
all of us are remote now. And then for the folks at Tax Foundation in the DC office, they're hybrid. So some of the time they are working remote, and we all travel a lot. What do states do right now to keep people from being taxed twice on the same dollar of income?
So when two states can both stake a legitimate claim to taxing your share of income, whether that's a day's worth of your income or your entire salary, if no other adjustments are made, that would obviously be double taxation. So that's obviously not desirable, and it's costly for taxpayers. And in many cases, that would violate the Constitution's Dormant Commerce Clause because that requires that taxes be fairly apportioned and prohibits states from just discriminating against interstate commerce. So we want to avoid double taxation. And to do that, states have adopted these credits for taxes paid to other states or other state tax credits. And basically what they do is that in every state with an income tax, they have these credits now. And so they are most commonly paid out by your home state, and they either offset the amount you actually paid in income taxes to other states that you may have traveled to, or the amount that you would have paid on that same share of your income if it had been taxed exclusively by your home state. So whichever amount is less is what gets offset by these credits. So if you live in one state but go on a business trip somewhere else, your home state can tax all your income from all sources, including the income you earned in that other state. But the other state can also tax the income you physically earned or that you earned while you were physically present there. So that's what would otherwise create this double taxation. And so when you claim a credit for the taxes paid to that non-resident state, that's offsetting. And so, you have to figure out, do you actually have to file in these other states? Because that's a whole question in and of itself. But assuming you do actually have to file there, the credit for taxes paid to other states does a great job of preventing double taxation in most normal circumstances.
Do you have an example you could walk through?
So to give you a sense of just how these credits for taxes paid to other states work, I'll give you a really simple example. So let's say you live in a state with a 6% income tax rate, but you take a business trip to a state with a 4% rate. So assuming you do actually have to file in that other state, your home state will offer you a credit against that other state's income tax liability to fully offset the amount you actually paid to that other state under its lower income tax rate. And then you'll pay the residual amount to your home state. But say the reverse is true and you live in a state with a 4% rate but travel for work to a state with a 6% rate, you will pay that full 6% to the state you traveled to. And then when you go to file your home state tax return, you'll claim that credit for taxes paid to the other state. But because your home state would only have taxed that income at 4%, your home state will only offer you a credit for the 4% or the amount you would have paid on that same income under your home state's tax rate. So that will wipe out any income tax liability on that income that you would have otherwise owed to your home state if your home state is the lower tax state. But the net of all this, regardless of which state has a higher or lower tax burden, is that when some or all of your income is taxable in two states, your total state income tax liability on that portion of your income will always equal the amount you would have paid to the higher tax state. But the credit for taxes paid to other states is the mechanism by which that revenue gets apportioned between the two states. So the bottom line is credits for taxes paid to other states really do a good job of preventing double taxation, but they don't do anything else besides that for the taxpayer. So you still do have to file in both states, which is burdensome, time-consuming, costly, all of that. And so, it doesn't do a whole lot for taxpayers actually, other than just removing that double taxation burden.
Now, just to give the listeners, I think, a little image, because this is tricky, is I live in New Jersey, and let's just say I'm going to go work in California for a while, and let's say I don't make the top rate, but let's say I get paid the big bucks, and I'm charged at the top rate in both states. So we're at 10, 11% in New Jersey, and then it's 12.5 or something in California. And at that rate, so there's still that 2% gap that's basically happening. That 2% gap between California and New Jersey that exists is what I'm still paying, and I get no credit for that.
You might apportion your income between the two states, but you would still pay on net the higher amount. So you can't avoid the higher tax state by virtue, if you're truly exposed to both states' income taxes, you're going to end up paying the higher amount. Okay. So it doesn't benefit you to work in a lower tax state, for instance, because your home state still can tax all the income that you earned in the higher tax state. And so it's ultimately kind of a wash. You have to pay that, or not a wash, but you have to pay the higher amount. But how it's apportioned depends on if you're falling under a normal credit scenario or under a reverse credit scenario, which is even more complex, and it's not worth getting into all the details there, but it's worth being aware that some states do have reverse credits where the credit is offered by the non-resident state and claimed against the person's non-resident income tax liability to offset the taxes that they paid to their home state. And so this does a good job of helping ensure that the home state doesn't end up in a situation where they don't have any revenue. That wouldn't make a lot of sense from a public finance perspective, because for the most part, even if you work 40 hours a week in another state, your home state is the one where you're going to receive most of the public services. Probably you spend more time on that state's roads, the local police and fire protection, protect your home. It's more likely that you'll need state services in your home state. And so we want to make sure that home states get a lot of that revenue, but under a traditional credit scenario, they can miss out on a lot of that revenue, or potentially all of that, depending on how long and how much of your income is being taxed by this other state.
So this is what happens, and it's a little confusing and complicated when things go right. But what happens when it goes wrong?
So there's a lot of different ways that this can go wrong. And I think one of the biggest examples of how this goes wrong is with what are called convenience rules, which is basically what happens when a state aggressively decides that they will tax remote workers whose employer is based in an office in that state, even if that employee themselves barely even makes any contact with that state. So these rules are in place in 8 different states: Alabama, Connecticut, Delaware, Nebraska, New Jersey, New York, Oregon, and Pennsylvania. Some are more aggressive than others, but basically they'll say, like, if you work technically out of a New York-based office, but you live in Colorado because you like to hike and ski and you want to live in Colorado, if that's not a necessity of doing the job, and that's just because you want to live in Colorado and your employer lets you live in Colorado, New York would say, hey, still owe income taxes on all of your salary that you earned from that employer, even if the contacts to that state are very minimal. So maybe you make one visit to the office for like a staff meeting or something like that. It depends. The rules vary state to state, but very minimal contacts could require that your whole entire salary, even though you physically earned it in Colorado, be taxed by New York. And so how this breaks down, though, is because you would still have to obviously file in Colorado, too, because you lived there, you physically performed the work there. But when you go to claim the credit for taxes paid to New York, you won't be able to do that. Colorado will probably deny it because that work was physically performed in Colorado. And so this has created a lot of issues. There was a lot of litigation over it during COVID. There was a lawsuit between New Hampshire and Massachusetts over this, where New Hampshire was upset that people who previously lived in New Hampshire but worked from an office in Massachusetts and previously had to pay Massachusetts income tax now were working full-time from New Hampshire. And so they were barely stepping foot into an office in Massachusetts that entire year, potentially 2 years after the pandemic started. And so New Hampshire was saying, hey, these people shouldn't have to pay Massachusetts income taxes anymore because they're not even in Massachusetts. Ultimately, the Supreme Court decided not to hear that case. So it still remains to be determined whether convenience rules like this are actually constitutional. There's a lot of reasons to believe they might be a violation of the Dormant Commerce Clause, but for now, they do remain on the books in several states. So it's really important, if you are a remote worker, to be aware of these, because you could end up facing full double taxation on your entire salary if your employer is based in one of these convenience rule states. And that also creates unintended consequences. If you're an employer that wants to offer remote work flexibility, but you're based in a convenience rule state, your employees are not going to be happy about that if they suddenly are surprised to find out that they owe 2 complete income tax bills to 2 entirely separate states. So that's one of the biggest ways this can go wrong. But there's also a ton of complexity in other areas, including in how it's determined when individuals have to file and pay and when employers have to withhold. So that's just the tip of the iceberg there.
So I do want to just pause here briefly for a moment to talk about the fact that this is crazy. Like, the purpose of taxes, and I mean, you could speak to this more, Erica and Katherine, better than I can as the experts, but my understanding is we get taxed because there are services, there's government, we want structure and society in our lives. We want schools, we want these different things that taxes provide. And if I don't live there, I am not being provided anything. And I'm also not a drain on their system where they need to tax me. This seems wild.
That's absolutely right. And the line has to be drawn somewhere. Their employer is maybe headquartered in New York, but just because your employer is headquartered in New York's not trying to tax every single person who works for a company that has headquarters there. The line has to be drawn somewhere. And, there's talk about like, how much are you availing yourselves of the state's economy? And again, it's not exactly clear where that line gets drawn, but there's definitely way more, I think, justification for you are physically present in the other state. New York doesn't get to tax you just because you are based out of an office there. Maybe if you spend over a month working from that office, sure, there might be a case to be made for then apportioning that share of your income. But should they really get to tax your whole entire salary? I would definitely argue no, and I think a lot of others would as well, but the jury is still out on this.
It feels common sense. Like, it feels like a common sense answer to say no, they should not get to tax you on your entire income if you're barely even stepping foot there. But there are some crazy laws as your paper lays out, Katherine, and really it's a patchwork. Things are different across each state in terms of filing requirements, withholding thresholds for employers. Can you walk us through what that patchwork looks like now as you laid out in your paper?
It's quite a wild patchwork of things. And really, in doing the research for this paper, it took quite a while to dig into all the state statutes to figure out all of the ways that states can vary on this. Because I was kind of surprised to find out that most states don't actually spell it out as clearly as maybe they should on their non-resident income tax forms and instructions. You oftentimes do have to go to the statute itself. And in some cases, the filing and the withholding parts of the statute are in completely different parts of the code. And if you have a convenience rule, that might be in a completely other part of the code. So actually figuring out, even when you are subject to this, that itself is a difficult question to answer, even if you specialize in this all the time. So, but basically, there's a wide range of this patchwork. So there are 22 states that have very aggressive laws where if you spend even a single day working in the state, technically, under the letter of the law, you are supposed to file a non-resident income tax return there. And you might have to pay depending on if you get to claim a prorated standard deduction or personal exemption and things like that. So you may or may not actually have to pay. But in 22 states, you have to file for a single day of work. And what constitutes a single day of work varies state to state as well. In some states, if you earn any income at all there, so that babysitting example, if you spend an hour working across state lines, there are some states where you do technically probably have to file and pay, although I'm sure hardly anyone does that. So there's a lot of aggressive states like that. But there are also some states that have made good progress on this, with a lot of states doing so even just since COVID. So we've seen 6 states adopt much more reasonable filing and withholding thresholds since 2020, which is really great to see. And so right now there are 4 states that have 30-day filing and withholding thresholds where you're allowed to work in the state for up to 30 days before any filing, payment, or even withholding obligations are triggered, no matter which state you come from. And so that really goes a long way to relieve compliance burdens for people who have a quick business trip, maybe spend a day or two in a state, or even a week-long conference, and are only spending a short time there. So those laws are the most generous, but then there are some states that have what's called mutuality requirements where they claw back some of that relief for certain taxpayers. And basically how that works is some of these states determine that if you come from a state, or they will only allow you to have relief under the filing and withholding threshold if you come from a state with no income tax, or a state that offers a substantially similar exclusion, and no state has done a good job of defining that. So who knows what actually constitutes a substantially similar exclusion? It's unclear, even to tax preparers, if like a $2,000 income threshold in one state would be sufficient to be substantially similar to a 30-day threshold in another state. But basically, states are saying, we will only provide relief to your state's residents if you provide relief to our state's residents. And while that may be understandable at face value, I think it's kind of petty. And I also think it creates a lot of non-neutrality because you are applying different laws to different people for no decision of their own, no behavior of their own. Like one state was there, or one person can be in your state from one state and they get taxed as soon as they're there. Another person can spend 30 days there, and it's just because of the laws at place in their own state. So it'd really be great to see more states adopt these 30-day filing and withholding thresholds without those mutuality requirements, because not only are they very non-neutral, but they create a lot of complexity too, because if you see that your state has a threshold, you probably assume it applies to you. You might not read the fine print and see that, oh, actually, it doesn't, depending on which state you come from. And sorry, we can't even define what a substantially similar exclusion actually is. So yeah, it's quite a mess when it comes to all of the different ways states go about doing this.
You could even imagine like two coworkers like traveling to a conference in one state, and depending on what their state's policy was, one of them may owe taxes for traveling to that conference and one may not. That is so wild.
Yep, that's exactly what would happen. So the employer would have to keep track of all their remote workers and be like, oh, Erica doesn't have to pay, but Kyle does, because that's just crazy.
They can't be
but that's the
generating
reality.
like enough revenue off of this for that compliance and administrative burden to even be worth it. Like
Not at all.
The paperwork cost to this has to be so much higher than any potential revenue just from like the average taxpayer.
I just wanted to hop in and say, it's definitively like not good to have laws that people don't really follow. Like, I think that there's this whole system here where it's like, okay, sure, you go to this state, that state, and you know what, Katherine, God bless you that you follow the laws that you need to for all your work travel. But a lot of people don't. But it's just, that's not a good thing. That doesn't like help our tax code. That doesn't like enforce that this is a good tax code or that people should be following tax laws.
No, it definitely doesn't. I think it's kind of laughable when you look at these laws and you're like, are you really wanting us to do this? Because no one, only very like higher earners do this. Athletes, professional entertainers oftentimes have to do this because of the clawbacks in different states. CEOs often, or higher earning people, tend to be a bit more careful about these laws. And people who work for very large companies that have major compliance departments that can actually adjust your withholding every time you travel. But most employers, I would venture to guess, probably aren't actually doing this. And when I've talked to different CPAs, a lot of them are like, they're not necessarily going out there to encourage people to be like, oh, did you tell me all the different states that you spent a day in? No, this isn't happening. So yeah, it doesn't make a lot of sense to keep laws on the books that people aren't complying with overall. Some certainly do in some instances, but it's very rare that someone will file a tax return for a day spent working in a state, or even a week. People might realize it's a thing when they spend a month there and start to keep that in mind. I think during COVID, when this became a big issue that everyone was talking about, there was more awareness about it. But in your normal day-to-day, if you might pay like just $6 to a state for a short time spent there, that's going to cost you way more to file those returns, even just using tax filing software, and way, way more if you're using a professional tax preparer. People are going to think that's silly. There's no way.
Can't even imagine like lawmakers expect people to do this. Like if it's buried in different parts of the tax code in each state and you have to like go search the actual statute and it's not even clear on forms, like your obligation to pay. Like when you talk with lawmakers about this, I'm curious, like what is their understanding of the policy, and are they on board with the current patchwork, or do they understand like this is a mess? If we were starting from scratch and designing something to fit today's economy, like what do they think?
Yeah, well, that's a good question. And it depends on the lawmaker. I think this is such a niche issue and so in the weeds that a lot of people aren't even aware, or it's not really on their radar. A lot of people will say, yes, we should definitely promote simplicity. Tax filing is already burdensome enough for most Americans. Why are we making it worse? You do see some of a desire not to lose revenue, especially for more of those high income earners like professional athletes and entertainers. And especially if you are a state that gets a lot of that, you're going to be hesitant to give up some of that revenue. And I think that's the major reason why we haven't seen a national uniform standard adopted. There has been legislation introduced year after year after year, the Mobile Workforce State Income Tax Simplification Act, to try to create a uniform 30-day filing and withholding threshold. But the main reason this hasn't been adopted is because there are some states that would lose out on this, even if overall, in order to apportion everyone's income just so, we're making everyone file and pay and basically apportion their income wherever they go. And, from a corporate perspective, there's corporate apportionment, but most people don't think about individual apportionment, but that's really what this has become. And it gets out of hand. I recently filed my income taxes a few weeks ago, and I did this mostly because it's an interesting thought experiment to try to go through this and deal with the pain of trying to figure out what states actually want people to do and go through with it. And so I had to go back through my Outlook calendar and be like, okay, I traveled to these 6 states, worked in these 6 different states. Here's the number of days I spent there. And then actually doing this through tax filing software, they will walk you through apportioning your income, and in different states, different ways. But in one state, I had to add up the number of working days versus PTO days versus vacation and sick days to be able to apportion exactly how much I owed there. And then when you go through all that rigmarole, in some states, you don't end up even owing anything because you then have to prorate the standard deduction and personal exemption and benefits like that. So you might have that filing requirement, but still, when all is said and done, owe $0, but the letter of the law says that you technically still have to file. And I can't think of anything that feels more silly than paying, $40, $60, $70 or way more potentially to file in a state that you owe nothing to. So yeah, it just gets really out of hand really quickly. And so I do think the more policymakers see just how crazy this gets, the more likely they are to want to create some sort of standard, as we've seen in a variety of different states, red and blue states alike. We have seen progress made toward 30-day filing thresholds. Illinois is a leader on this. They adopted a 30-day filing and withholding threshold, and it's great to see more and more states moving in this direction. So that would be one of my biggest recommendations to lawmakers, is just to consider doing something like that.
You mentioned that you didn't owe anything. You got to the end of the process and you had $0 to pay. But that's definitely not true for some people who travel a lot. Can you talk through some of the exemptions or the exceptions to the rule, for key employees and athletes, and what it looks like there?
So even I owed a little bit to New York. So because I was there long enough, I did actually have to pay in New York. But the other states, no, didn't owe anything. But a lot of people who are professional athletes or entertainers who might spend a day in a state, but they earn a substantial sum of money for a game they play or for a concert they perform at. For those people, there are often clawbacks from these filing and withholding thresholds, and they do have to file no matter how much or little income, just by virtue of their profession. So that's commonly known as a jock tax. Even in the states that have adopted 30-day thresholds, most of those states, if not all of them, do have clawbacks for professional athletes and entertainers. But one of the problems with this is that those laws and definitions are way too broad and capture a lot of people who aren't high income earners. It's not just capturing Taylor Swift and LeBron James. This is capturing their backup dancers or their tour managers or their athletic trainers. And even I live in Nashville now. I'm friends with a lot of musicians who haven't made it big yet, but they tour the country and they perform and they earn money for the concerts they give around the country. But then they also come home and they're a waitress or they do other things to make ends meet. That's not really the type of people that these laws are trying to go after. But technically, if these people did comply with all of these laws, they would be filing in potentially dozens of states and dealing with all those filing fees. So it's very difficult to imagine any scenario where any lawmaker would want to actually capture your average person who spends a day somewhere else or, earns a small amount of income.
And again, this is all largely outside of the, Taylor Swift, LeBron James. This is all largely a negligible amount of money. This is not people who are making tons of money. This is just a an unnecessary burden on the citizens and the tax code itself. But there's something on top of this. There's also a local layer to all of this. Is that right, Katherine?
Yes, we haven't even touched on the local layer, yes, but there is. And so on top of all this, there are numerous states that have local income taxes. So right now there are 16 states that authorize local income taxes. 14 of those do sometimes or always apply to non-residents. And so in thousands of different jurisdictions across the country, if you spend any amount of time working there, you might have to pay local taxes in addition to state taxes. So for instance, some states like Missouri, you only have to pay in Kansas City or St. Louis because those are the only two jurisdictions with a local income tax. But in Pennsylvania, they have over 3,000 different local income tax jurisdictions that are all self-collected. So they're administered at the local level. So you have to, I guess, look up exactly, which jurisdictions you worked in. So potentially many different jurisdictions if you're traveling throughout the state while you're working there. And then technically you're supposed to remit payment. But of course, that's going to be such a negligible amount of money for most people if you're spending only a day or a week or something, even longer than that working, and you're paying like 1% of the amount of money you made that day or even less. Overall, local income taxes are complied with even far less by non-residents, but technically they still remain on the books. And I think we have to think about the justification for this. And clearly there's a desire to tax non-residents. But then you have to think about the other ways non-residents are remitting revenue to pay for their time in the state. So there are sales taxes, there are excise taxes, they are paying on their restaurant meals and on their ride shares and their hotels and all kinds of different things. So does it really make sense to also require them to pay local income taxes where it's a very taxpayer active, burdensome process when they're probably going to remit way less under that than they would by just paying sales taxes to states and localities?
So we've talked about how the compliance cost of all of this on the taxpayer, like the cost to file a form and then find out you owe $0 or some small dollar amount, is a big waste. It's also a big waste for governments to process a lot of these returns that end up, generating little to no revenue. And you mentioned some states have adopted reforms since the pandemic, moving to these kind of like aligned filing and withholding requirements that make a lot more sense. But if you were talking to like a state legislator right now, what's on your wish list for reform, and how do you pitch lawmakers to care about this issue?
So I think the number one reform would be to consider adopting a 30-day filing and withholding threshold with the filing and withholding thresholds that match. Don't make it confusing by making the thresholds different. And avoid clawing back those safe harbors. So avoid things like mutuality requirements and key employee rules where you're trying to tax specifically high income earners or executive level people, but not everyone else. Avoid overly broad jock taxes. So make sure that if you are going to claw those back for people like athletes and entertainers, to make sure those definitions are very targeted. And then adopting reciprocity agreements is another good one that we haven't mentioned yet. But basically, reciprocity agreements are an old tool, but they have a very good application to this modern conversation, in that there are a lot of states now where if you cross state lines and you're a cross-border commuter, states will mutually decide that you only have to file and pay in your home state, not the other state. And so these save a ton of hassle for people in both states, and they save compliance costs for states because you are going to have far fewer non-resident returns to process if you're going to knock out your neighboring states and say you're not going to process those returns. And then you have far fewer credits for taxes paid to other states that you have to issue. So those are a good reform to consider. And I definitely say either avoid convenience rules altogether, or if you already have one, to consider repealing that. And then if you have a local income tax, to avoid applying that to non-residents. So there are states like Kansas and Kentucky that do have local income taxes, but they don't apply those to non-residents. So that's helpful. But I think overall, it's the simplicity argument, both for taxpayers and the state, is the best argument here in favor of moving towards simplification. There is a little bit of revenue at stake potentially, but all things considered, if you're focused on efficiency and tax friendliness, there are a lot of economic growth benefits there and a lot of potential revenue benefits there. So I think one really interesting study is done every year by Cvent Holding Corporation. They have a top 50 meeting destinations in North America list. And in 2024 and 2025, and probably many years before that, a lot of the top meeting destinations were in states that either have no income tax at all. So those residents and employers definitely don't have to worry about filing or withholding, or they're in states that do have at least some amount of a non-resident filing and withholding threshold. So of the top 10 cities, in 25, those were Orlando, Vegas, Chicago, Nashville, Atlanta, Dallas, San Diego, DC, Phoenix, and Denver. 5 of those cities are in states with no income tax at all, or that don't tax non-residents at all. And the others, Denver's the only one that requires filing and withholding on day one. All the others have some sort of non-resident safe harbor. So tax friendliness can really go a long way in terms of drawing people and businesses to your state, making it a good place, not just to live and work, but also to travel and to, work while traveling. So I think as long as states are wanting to find ways to make their tax codes more competitive and if that's the goal, these reforms that I just mentioned fit very appropriately in that type of goal, if your mindset is competitiveness.
Where do you think the momentum of all of this is heading? Like, what do you think we're going to get cleaner state taxes? Is it going to get better, hopefully, worse? What do you think?
I do see momentum toward adopting better safe harbors. So there's definitely been momentum since COVID in more states moving toward 30-day filing and withholding thresholds. Would love to see that momentum continue. Last year, I believe it was Alabama adopted a 30-day filing and withholding threshold for the first time. And then Louisiana increased their threshold from 20 to 30 days and got rid of their mutuality requirement. Although I do believe Alabama, in adopting their threshold, they did include that mutuality requirement. So not all of these laws are perfect, but even last year, 2 states made very good progress. Would love to see more states do so again this year. So the momentum is a little slower, perhaps, than we might like, but there's definitely momentum. I think the 2 states that made solid reforms last year, that was really great to see.
Katherine, thank you so much for being on today. Erica, thank you for joining, as always, as my co-host. I want to point you quickly to our website, taxfoundation.org, where you can find Katherine's wonderful paper, which is titled Non-Resident Income Tax Filing and Withholding Laws by State, 2026. Katherine, this was wonderful. You broke down all of these complex, confusing, and sometimes inane laws in a really wonderful way to help listeners understand. For our listeners, before we sign off, if you have any burning questions, you can send them our way. You can drop a comment on YouTube. You can email us at podcast@taxfoundation.org, or you can slide into our DMs at DeductionPod on Twitter. Thank you for listening.